A small business investment company is a designation put forth by Congress in 1958. It specifically provided banks the opportunity to participate in mezzanine and private equity, sometimes venture that they otherwise wouldn't be able to. The SBICs are really gaining favor with banks since the crisis, and their expansion and participation has increased greatly. It gives them the opportunity to participate in an asset class they otherwise wouldn't. It gives them CRA credit, and also the SBA matches any investment 2-for-1 as a preferred LP that essentially leverages the return for the investors. SBICs, or small business investment companies, comply with CRA, or Community Reinvestment Act, in a very specific way that no other CRA investment does. You get the credit without looking to the underlying credit. No other CRA product has that. You always have to look to the underlying credit. And the way it works is that the fund only has to promise to market in the investor's target assessment area for CRA. It doesn't have to invest. So basically, you've moved from a higher risk product to a much, much lower risk product for a bank to participate in the CRA, which is really an amazing thing when you think about it, because on its own, even without the CRA, is probably the highest risk reward investment that a bank can make. One of the ways that SBICs help manage interest rate risk for a bank is it provides diversification. It's diversification that otherwise wouldn't be available to an asset manager at a bank. Over 80, probably 90% of the assets in a bank are tied to duration. So they have interest rate risk embedded in the whole balance sheet. The ability to diversify into private equity or mezzanine, and something that's not so dependent on interest rates and where they are, is a huge opportunity to diversify for a bank to where they're similar to an endowment or a foundation or a pension fund that manages it on a regular basis. There are some good SBICs, there are some bad SBICs. I've seen banks invest with very little due diligence and perform very badly in SBICs. Much the same as a loan. There are good loans and bad loans, but it doesn't mean all SBICs are bad. There needs to be a process, and banks are set up to do process with loans, investments, deposits. They're not typically with SBICs. It typically goes to a CRA person in the bank that has very little investing experience. So unless the board and the bank management can add that experience to the due diligence process, they need to seek outside help. Boards and management teams can help ensure the success of SBICs in several ways. One, they need to develop a relationship with the SBIC rather than just invest in it. They should market to the SBIC to participate in the senior loans that are in their assessment areas. They should try to get the deposits from the participating companies. It's a great way to build C&I business for a bank. And then lastly, they can participate on the advisory board of the SBIC. That way they've got a continual contact with the SBIC on a monitoring basis. That way there's no surprises in case there was a bad investment or issue with the SBIC.